When it comes to investment in stock market, there is one name that is a big source of inspiration for every investor. It is none other than Mr. Warren Buffett. He is by far the most successful investor in the world and among the top 5 richest people in the world. Personally, I am a huge admirer of Mr. Warren Buffett. Over the years, I have personally learned a lot from him, and that has set up a solid foundation in my investment journey. Hi everyone, my name is Sahil and this is my Personal Finance Academy. So in this video, I want to decode 10 timeless lessons from Mr. Warren Buffett that would help you become a better investor. Alright, let's get started. So number one lesson is, Warren Buffett says, you don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with 130 IQ. So generally people have this notion that finance and investment requires a lot of knowledge. You need to have MBA in finance or CFA and so on. And it is not a cup of tea for normal people. But Warren Buffett says that investment is not a rocket science. And there is no guarantee that a guy with an IQ of 160 would beat a guy with an IQ of 130. The problem is that basic finance and money management is not a part of school curriculum. Nobody really teaches it. Hence, it looks very difficult. But all you need is some common sense to pick good stock for investment. I personally had an engineering background with zero knowledge about finance and investment. I also used to feel that finance is a super complicated subject. But fortunately, I read the right books, blogs, articles, and built the knowledge around finance and investment. So if I can do it, even you can do it. His second quote is around the human emotion of fear and greed. He says that we simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. This is probably one quote that the majority of you would have heard before. But trust me, it is very difficult to implement this quote in the real world. It is because we humans are risk averse. So we tend to follow the crowd. So what happens is that when there is a bull market, everyone is investing in the stock. And that makes us greedy, and we also end up investing with the crowd. But when there's a correction, everyone panics, and we also end up selling stocks out of panic. Whereas Warren Buffett does the exact opposite. He buys when everyone is selling and doesn't get greedy during the bull run. For example, during 2008 financial crisis, Goldman Sachs was almost on the verge of bankruptcy. Everyone was selling the stock. Its share price tanked more than 70%. At that time, Warren Buffett invested almost $5 billion in Goldman Sachs, although he got the preferential share as he had the bargain power. But that investment resulted in huge profits for him. Likewise, during 2021 bull market, when everyone was investing, Warren Buffett company Berkshire was sitting on a cash pile of $150 billion because he knew that markets are overvalued. And eventually we saw some correction in the market. So be fearful when everyone is greedy and be greedy when everyone is fearful. His third quote is on the business. He says, in business, I look for economic castle protected by unbreachable moats. Okay, let me break down this quote. What he means is when he invests in a business, he look at the moat. So during the 17th and 18th century, kings would have castles and surround them with moats full of water so that enemies can't breach them. That is exactly what he looks for in the business. Thick moat that competitors can't breach. Here moat means competitive advantage. So he likes to invest in companies that have a strong competitive advantage. For example, look at Coca-Cola. It is the most popular soft drink company in the world. It has created such a strong brand name that it has a very loyal customer base that only drinks Coke. Apart from brand name, Coca-Cola has a very strong distribution network with presence all over the world. And of course, it has a secret formula that is hard to replicate. Apart from this, Warren Buffett invested in Apple in 2016 with an amount of $36 billion. That is worth $160 billion today. Again, Apple has created such a strong brand name that it has a die-hard fan following. And people are willing to pay a premium price for Apple products. This type of moat is really difficult to replicate, and hence it gives a huge advantage to companies with strong moat. So make sure that when you invest in a company, always look at the moat, that is competitive advantage. It could be a brand name, distribution network, patent, strong financial profile, or a combination of all. Warren Buffett says the 3 most important words in investing are margins of safety. That means to buy stuff on sale. That means pay less than what it is worth. That means to buy $10 bill for $5. Warren Buffett has been a value investor for his life and always look at stocks available at discount to their fair value. He says that whether we are talking about socks or stocks, I like buying quality merchandise when it is marked down. Here, margin of safety basically means buying stocks at a discount to its actual value. For example, if a stock has a fair value, also known as intrinsic value of rupees 500, and if it is available at rupees 400, then it is trading at 20% discount to its fair value. He always invests in companies available at discount, and that is the reason he did not invest much during the 2021 boom, because majority of stocks were trading at crazy valuation. He knows that eventually there will be a correction and that would again create buying opportunity. Fifth quote is on long-term investment. He says, I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for the next 5 years. There is another quote. He says, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Unlike traders, Warren Buffett is a long-term investor. He is very peculiar with his investment and takes a lot of time before investing. But when he decides to invest, he invests for long term. For example, he invested in Coca-Cola in 1994 and still holds an investment. He held shares of Wells Fargo for almost 3 decades before selling them in 2020. In fact, there are many examples when Warren Buffett invested years back and still hold them. Today, the majority of young investors look at short-term picture. If the stock doesn't perform well, they would sell the stock. And even if the stock gave good return, they would book profits. So Warren Buffett's lesson is simple. If you can't own the stock for 10 years, don't even think about owning it for 10 minutes. Warren Buffett says that only when the tide goes out do you discover who has been swimming naked. This is a classic quote from Warren Buffett. Here, Warren Buffett is basically trying to differentiate between a good company and a bad company. What he means is that during the bull run like in 2021, the stock price of every company would jump. Even the stock of fundamentally poor companies would rise. But it is only when the business condition worsens or when the stock market falls, it will differentiate the winners from the losers. In fact, it is the difficult time that would help you identify quality stocks because during good times, every company would jump. So it is not possible to differentiate a good company from bad company. For example, in 2022, there are multiple challenges, including rising oil prices, increasing interest rate scenario, rising inflation, etc. These challenging environments would clearly differentiate the winners from the losers. His next quote is on reading. He says, read 500 pages like this every day. That's how knowledge works. It builds up like compound interest. All of you can do it, but I guarantee not many of you will do it. It is no secret that one of the biggest reasons behind success of Warren Buffett is reading. He used to read 500 pages a day. He says that I read and think, and that makes less impulsive decision than most people in the business, and that is very uncommon in American business. A lot of investors panic when the stock falls 40 to 50% because majority of them invest based on tips. They don't read about the business of the company. So when the quality share fall, rather than buying at discount, retail investors end up selling the stock out of fear because they have no clue about the business. And I keep saying that if you want to invest with conviction, you have to read about the company. What is the business? Understand their model, their strength, weakness, future plan, key risk, financials, valuation, and then make an informed decision. But unfortunately, very few people read those details in the annual report because it is very boring. But trust me, when you read, you build knowledge. And eventually that knowledge compounds. By the way, there's an interesting book that I would recommend you to read. It is called The Warren Buffett Way. This book is written by Robert Hangstrom, who closely studied Warren Buffett for years and explained his investment philosophy in 12 timeless principles. In case you don't like to read, you can listen to this book summary on Kuku FM, which is India's leading audiobook platform with 1,000+ hours of content. This book summary is available in Hindi language. In fact, there are many other financial book summaries on this platform that you can access in different languages like Hindi, English, Gujarati, Marathi, etc. By the way, this platform is not only limited to financial books. You can access book summaries across domains like self-help, motivation, culture, etc. Now, next quote is on the long-term investment in the stock market. He says, over the long term, the stock market news will be good. In the 20th century, the United States endured 2 World Wars and other traumatic and expensive military conflict. The Depression, a dozen or so recession and financial panics, oil shocks, a fly epidemic, and the resignation of a disgraced president. Yet, the Dow rose from 66 to 11,497. So this quote was mentioned in 2008, and today Dow Jones is at levels of 35,000. That's more than 3 times when Warren Buffett made the statement. And it is so true. We generally tend to get influenced with short-term movement. What is happening in Russia, Ukraine, what is interest rate, what would US Fed do, and so on. And in this process, we miss out on the long-term bigger picture. If you look at the history, even India has faced many challenges. We have been in war with Pakistan and China. We have seen many scams, including Harshad Mehta. We have seen multiple global recession, including 2008 housing bubble burst. Recently, we have seen COVID. That was one of the biggest catastrophes in the last 100 years. Yet, we have overcome all the hurdles. And during the last 40 years, Sensex has jumped from levels of 100 to currently at 60,000. So Warren Buffett is very clear. He says, I can't predict the short-term stock price movement. I don't have any idea whether stock will be higher or lower in the next 1 month or 1 year. But he says that in the long term, stock market will touch new heights. And this is certainly applicable for Indian stock market. Nobody knows if Sensex would touch 55,000 or 65,000 in the next 1 month or 1 year. But it will eventually touch the level of 1 lakh or 2 lakh in the long term. Next quote is on patience and discipline. He says, successful investing takes time, discipline and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. Warren Buffett's journey is a classic example of discipline and patience. Today he is worth more than $125 billion and among the top 5 richest people in the world. But you would be surprised to know that he became a billionaire at the age of 55. So it took him 33 years to become a billionaire, and that happened due to investment with discipline and patience. Unfortunately, today people want to double their wealth in 3 months or 6 months because they lack patience. They don't understand the power of compounding. So if a stock falls 40 to 50%, retail investors would panic. They might wait for stock to recover for the next 2-3 months and then they will lose patience and end up selling it. The problem is that retail investors only look at the short-term picture. They miss out on the long-term opportunity. India is a country with huge growth opportunity for the next 20-30 years. And if you stay invested with patience and keep investing with discipline, you are going to make a lot of money. Final quote is on personal productivity. He says, the most important investment you can make is in yourself. Now this quote is especially apt for young investors. The moment they start making money, their only question is where to invest. Now there is nothing wrong with investing the money, but just imagine, you invested in a stock that became a multi-bagger and generated 10 times return, but you invested only rupees 5,000. Now will it make a big difference in your life? Not really. But what if instead of investing 5,000 rupee, you had invested rupees 5 lakh? A 10 times return on 5 lakh would have become 50 lakh rupee. Now that's a significant amount of money. So in this video, we discussed the 10 timeless lesson from Warren Buffett. Trust me friends, if you follow his advice, you can also create huge wealth. In fact, there's a famous Indian American investor and businessman, Mr. Monish Pabrai, who made billions by simply cloning Mr. Warren Buffett investment philosophy. Of course, it is not easy for everyone to replicate the success. But even if you learn 1% from Warren Buffett, it would certainly help you in your financial journey. I hope you'll find this video useful. Now tell me in the comments which is your most favorite quote of Warren Buffett. I'll see you next video. Till then, take care.